Tesla reported their full year 2023 earnings on January 24th, and though revenue was up 18% to $97 billion, the market sold the shares down about 10% after the announcement. If we take a closer look at the income statement, we can see gross margins are actually down 15% year over year to 18%. Operating profit was also down 35% to $8.9 billion. However, net income was up 19% to $15 billion. Tesla recorded a $5 billion tax credit for 2023. Without the tax credit, net income would have been down around 20% year over year. Tesla's market cap stands at $652 billion. Taking a look at the 5-year revenue picture, we see that revenue has been growing 31% compounded annually. The last 5 years' gross profit have been up 34%. Profitability didn't come in until 2020, so the 3-year growth rates are more telling. Net revenue grew by 21%. Gross profits has been growing at 9% for the last 3 years, operating profit by 11%, and net income by an impressive 40%. Definitely good results. The business segment revenue clearly shows that automotive sales have been the primary driver of Tesla's success, growing 31% in the last 5 years and 21% in the last 3 years to reach $78.5 billion. Turning to their other segments, the energy generation storage unit has been growing at a clip of 30%, give or take, in the last 3 and 5 year periods, respectively. Though it's hidden in the graph, energy generation grew by 50% year over year to $6 billion in 2023. The service business has been growing at 30% as well for the last 5 and 3 year periods to report $8.3 billion in 2023. Turning to the market value ratios, there was a slight increase in the shares outstanding by 10 million. Earnings per share was $4.30, growing by 19%. As mentioned earlier, the tax benefit for 2023 boosted EPS artificially and would have been about $2.87. Sales per share were $27.80, growing 18.5%. Cash per share was largely flat at $4.71. Book value did increase 40% to $18 per share. The price-earnings ratio shows 43.5 compared to the S&P 500 at 26.3. Based on PE alone, Tesla is overvalued, and this number is after the sell-off on January 25th. PE growth is strong. Leverage ratios show that debt ratio and debt-to-equity ratio to be very low at Tesla, reporting just 0.03 and 0.05 respectively. Interest coverage ratio 8 times suggests short-term interest payments are more than covered. Definitely favorable ratios. The current ratio at 1.73, the quick ratio at 1.13, and the cash at 0.57 support that Tesla has no liquidity problems at all. Return on assets was just 14% last year, down 8%. Return on equity was 24%, down 15% from 2022. Return on capital employed was 11.4%, down 54%. And return on invested capital was also lower to 23%. Tesla's cash flow is strong. Operating cash flow was slightly lower to $13.2 billion. Investing outflows increased by 30% to $15.6 billion. Financing cash flows were positive, principally due to lower debt payment, and free cash flow to the firm is a very good number at $17 billion. Tesla doesn't pay a dividend, it's still a growth company, though we think that is changing. The enterprise value of Tesla is around $640 billion. That gives it a valuation of 6.6 times revenue and 37 times free cash flow. Market cap to net income is 43 times. Our key takeaways on this report: on the pro side, obviously the revenue growth has been solid. The free cash flow at $17 billion is very good. The company has lots of cash and debt is low. On the con side, profitability is overstated due to the tax benefit, though still positive. Margins are being squeezed. The PE is much too high compared to the rest of the market. The electric vehicle industry as a whole has seen other U.S. major car manufacturers closing down their EV business. We've seen the negative news on electric cars not starting due to the extreme cold, the news that car dealers aren't moving inventory either. Also, the challenges of lithium harvesting don't help costs. We give Tesla a rating of neutral. Though we see revenue growing, margins are squeezing, and the EV industry may not be as rosy as they say it is. We have no exposure to this company. Like and subscribe.